Welcome, this is your Option Monster Volatility Sonar Report. From the floor of the CBOE, I'm Jamie Tyrrell with Group 1 Trading. Well, it's another down day for the market. In the last 3 days last week, we were down 5% in the S&P 500, the Dow, all major indexes. Today we're down another 2% as everyone's waiting for a number of big earnings to come out this week to gauge where the direction is heading from there. In the VIX, we've seen a lot of activity. We're coming up on expiration. After today, there are 5 trading days left in the January expiration cycle. So we will settle on the opening print of the S&P 500 next Wednesday. Now, when the VIX settles, the January will settle off of the 30-day forward options. So the January VIX is going to settle off of the opening prices on the February S&P 500. So depending on what volatility those are running, we will get what settlement price for the VIX will be. So right now, if you look at the VIX chart, the January future has popped over 45. So with a number of down days in a row, we've gone from about 39 to 45, really moving towards the upside. And people are playing those upside calls, the 50s, the 55s, the 60s. We've seen a lot of buyers and sellers. Today we saw electronically a very large investment firm come in and sell those 55s for 60 cents. They sold 3,000 for 60 cents. They were sitting on the screen for about 3 seconds and everybody snatched them up and bought them. And then about a half hour later, we had a major retail bank come in and buy those same calls for 65 cents. So they traded 60, they've traded 65. They're right in that area right now. Lots of January trading, most of the January trading upside calls. Another trade we've been seeing is the March 50, 60, 70 call butterfly. We've talked about butterflies a couple times before, but just a quick review. When you buy a butterfly, you're buying the outside strikes and selling 2 of the middle. So in this case, you're buying the March 50 call, you're buying the March 70 call, and you're selling 2 March 60 calls. Now a butterfly is it's a limited risk, limited reward bet. It is always worth something. The 50s and 70s, in this case, the outside strikes are always worth more than the middle strike. So in this case, the 50s and 70s are over. If you bought them, it's worth somewhere between 0 and the distance between the strikes. So it's worth somewhere between 0 and $10. Now if it settles right at that middle, 60, it's worth $10. If it settles 55 or 65, it's worth 5. If it settles 50 or 70, it's worth 0. It looks like a big triangle. The peak is $10, 50 and 70 are 0. And it declines straight line from there. So in this case, the customer paid 90 cents to buy 3,500 of these. And they're making a bet that volatility could settle north of 50, below 70. If it settles at 60, their best point, they make $9.10. If it settles at 55 or 65, they'd make $4.10. So what they're doing here is a cheap shot, 90 cents to possibly make as much as $10. The crowd was selling these, but it's a shot. It could be worth as much as 10 to 1, it could be worth 5 to 1, it could be worth 2 to 1, and if we settle anywhere below 50, it'll expire worthless, they'll lose their 90 cents. But it's a shot the customer's taking that we're going to settle north of 50, south of 70, and that's the big trade we're seeing in the back months today. So that's called a butterfly. Jamie Tyrrell, Group 1, Option Monster.
Any of you boys seen an aircraft carrier around here?